What is mark to market and why is it mandatory for investment banks, hedge funds, and large commercial banks taking positions in the stock market, bond market, or FX markets? Hello, everybody. I'm a learning partner, Sushila Hariharan. And if you're interested in a career in banking and global financial markets, do subscribe to my YouTube channel where we provide content centric, research focused videos on a multitude of topics focused on global financial markets. Over here, we're going to discuss a very small but critical aspect of what is MTM or mark to market. As we know, the markets trade almost $1 trillion, especially in FX. In bond markets, which are more localized in nature, the trading exceeds billions of dollars every day. These could be across different assets, including equities, bonds, foreign exchange, commodities. These could be into different segments. These include the spot market, the futures market, the forwards market, the options market. And we are talking about daily trade running into trillions of dollars across the world. And a single bank itself, especially if you're talking about the large five banks in the world, which include JP Morgan, Citibank, Bank of America, etc., these are the banks that have large trading positions running into billions of dollars, whether in the overnight market or in the 1 week market or in the monthly market or even over a period of 6 months. Sometimes they enter into 5 year interest rate swaps, right? So in these cases, especially, we find this is mandatory. That is, all the traders' positions, all the outstanding positions are mark to market. Mark to market is a daily valuation of the outstanding positions of the bank. This is a very important step in recognizing what is the unrealized profits or losses for the bank. As we know, the treasury team, especially the dealing community, is a very small set of people, and they run books which run into millions of dollars, and therefore it is very important for them to have a control over what is the profit or loss, the P&L of the trading position, because this is exposing the bank to significant vagaries of geopolitical crises, excuse me, macroeconomic uncertainties, ships, tariffs, cargo embargoes, etc. So all these play a havoc in the markets. Depending on which market it takes place in, it plays havoc in the markets across the world. For example, as we can see, the geopolitical situation now is that there are different mini wars being battled out in different parts of the world, and of course the equity markets and the bond markets and the commodity markets and the oil markets are going to have some bit of a reaction to that. Over here, we must understand that dealers and traders are unlike investors who tend to hold on to positions for a long time. The traders are typically, a mindset of the trader is that of a very short term to short term. That means, since they're playing with largely client money or investors' wealth, they normally enter and exit into positions which are profit making or loss making at a blink of an eye. Over here, it is important to understand that they have to realize the profits. They have to also encourage the dealers to mitigate the losses and stop loss very adversely moving prices, in order to help the banks and the dealers have a greater control over their assets and liabilities, especially with respect to the price fluctuations that take place in the spot market as well as in the derivative market. Mark to market is mandatory for all the banks. This means that every bank is creating a unrealized profit or an unrealized loss kind of a valuation of their outstanding positions. This is pretty simple in the case of the spot market, because the stock exchanges naturally disclose what would be the daily closing price or the daily settlement price, and this price is the price at which the contract is valued. If it is a loss making contract, then the trader might want to exit the position. If it's a loss making contract in the futures and forwards, then they may have to post additional margin. On the other hand, over here in the case of a profit, they also want to recognize and realize the profits because they need to return the capital back to the shareholders and the money back to the depositors. These both situations arise in banks because they're really actually just raising capital from different depositors, especially investors in their certificates and deposits and things like that. Banks really make money by managing money, and this is one of the most important aspects of mark to market. If the bank dealer feels that the mark to market is a very important non negotiable trading position, then they would find that as soon as losses are detected, they might want to exit the trading position. This helps them decide what can be the next strategy, what can be the next day's trading strategy before they initiate a position in the markets. This is very important, and this daily valuation of outstanding financial contracts is done by the middle office department. What about the derivative segment? In the derivative segment also, especially in OTC derivatives, where there is not much of price transparency and there is more opaqueness with respect to the valuation of forwards or interest rate swaps, the price determination of the settlement price or the closing price is much more cumbersome and generally follows the best practice or adopted by other banks. This helps the bank keep a control of its cash position, of its collateral position, and most importantly of its P&L. This also gives the dealer a chance to recover the losses while deciding the next trading strategy. MTM therefore is a very important aspect of valuation of daily outstanding financial contracts done by the middle office of most of these banks.